Welcome to the December Economic Update. On the next slide you'll see our agenda for today. Particularly we wanted to focus on, because it's been so much in the media, on Bitcoin and cryptocurrencies. On our next slide you'll see our universal summary for what's happening in the world. As always, there's never a direct only good case for investment or a completely negative case for investment, and we always take the good, the bad and the ugly when we look at making any investment on your behalf or when we look across any asset class. Nothing's changed from this slide from the last quarter, but particularly good, we need to understand that monetary conditions are very, very highly stimulatory at the moment. That's a good sign. But on the bad side, we think that interest rates around the world will start to rise, and we believe that bond yields around the world will start to rise as well. And this is going to have significant implications for how we position your investments in your portfolios going forward. On the next slide, we actually begin with our fundamental views. Once again, nothing has changed here from the previous quarter. It's just very important to point out that as interest rates start rising, that is interest rates and bond yields around the world, it's going to have large implications for your portfolios. We have already pre-positioned you for this. We're in floating rate corporate notes. We are in businesses that we believe won't be too badly influenced by the first few interest rate rises in the economic cycle. I also want to make the point is the first 4 to 5 interest rate rises in an economic cycle are very, very good for stock markets. The US, in a couple of days' time, will see their 5th interest rate rise in this cycle. Over those 4 to 5 interest rate rises that they've had, the US stock market has come up to all-time records. So certainly the first few interest rate rise in a cycle are a sign of strengthening economics, which actually allows businesses to make more profits, which actually allows businesses to pay larger dividends. So we are not fearing the first few rounds of interest rate rises. Of course, towards the end of the cycle, interest rate rises start to have a big effect on businesses or individuals with a lot of debt. And that's where there can be some economic pain. That for Australia is some years away yet. On the next slide, of course, we are still just treading carefully. With interest rate rises coming up in the cycle, it's important that we moderate our expectation of returns. The other thing happening is share markets around the world, in Europe, in Asia, in the US, have seen these positive economic times, the synchronized global growth that we're experiencing, and it's already started to price that in. So we've seen large movements, particularly in international shares, and we'll be touching on that a little bit later. But a lot of this good news is already priced in. So as the good news comes through, we don't necessarily expect further large increases in shares, particularly on foreign markets. So as we look out the next few years, be aware that we think that growth in markets from here will be somewhat tempered. On the next slide, you'll see where we are in the economic cycle. So we have spoken several times about coming out of the reflationary defensive phase of the economic cycle and into the cyclical growth phase. I'm going to have some comments for you very soon from Kerr, Neilson, CEO of Platinum. He talks very much about what's happening in Asia, what's happening in China, and you'll see that his comments provide further evidence that we are moving into that recovery phase of the economic cycle. That is particularly good for shares around the world, but particularly those that relate to cyclical growth. And on our previous slides, we've talked about moving monies from defensive assets, across to cyclical growth assets. The next piece I want to talk about is viewing share markets as a clearinghouse. In past examples, we've given you We've looked at the share prices of certain stocks. We've seen large share price falls, and then we've seen big share price recoveries. And the main point that we've been trying to make to you is share price does not equal value. When a transaction happens on the Australian Stock Exchange or any stock exchange around the world, it's important to realise there isn't some government regulatory body sitting on top of that transaction to say, yes, just because you paid that for a particular share, that is actually what it's worth. That can't be true. If we think back to the September quarter and the June quarter economic update, we showed businesses like Livehire that went down 50% in a 6-week period, and then from there actually rose almost 1,000% over the next year to 18 months. And there was definitely no loss of value in that business, nor was there an immediate gain of value in that business. So it's very important, share price does not equal value. We also showed examples with Santos of tax loss selling into the 30 June and then a large recovery in share price. We also showed examples with Platinum of a large share price fall to 30th of June, and after tax loss selling had finished, a large rise in share price. So to give you the market as a clearinghouse example, I'm going to look at the cattle index. The blue line on the graph in front of you, you'll see some very big dips and falls. The background to beef consumption in Australia is beef consumption has been flat to slightly declining across 50 years. Very, very stable fundamentals of Australian beef demand. The big falls you see in the cattle price, and my father used to be a cattle auctioneer, so I'm very familiar with how the clearinghouse auction yards around the country work. The big dips you see happen in drought years. Normally a farmer might bring 500 cattle to market or 1,000 cattle to market over a year to sell them. In a drought year, there's no pasture. There's nothing that the cattle can eat. From the farmer's perspective, he needs to reduce the size of his herd, otherwise they will starve and die. So instead of bringing 500 or 1,000 cattle to market, he's showing up to market with 5,000 or 6,000 cattle. Now beef demand is flat. There's no increase in beef consumption in Australia, but a lot more cattle start arriving at the cattle auction yards. And the cattle auction yards price clearing mechanism, clearinghouse mechanism, is if larger supply comes on, the only way you can clear larger supply is a drop in price. You make it cheaper so people want to buy more. That's how you get rid of big supply. So in those years like 1996 or 2001 or 2002 or even 2013, 2014, those dips in that price chart are years of drought where farmers brought a lot more cattle to market to sell. But because this is a long-term price graph, it's not really showing you how bad it was in the short term. Because during those years, many farmers bought cattle to market, but there simply wasn't a buyer. They might have bought 5,000 cattle and someone bought 2,000. They would then approach the buyer and they would say, look, you bought 2,000 cattle today, I've got another 3,000 sitting here. If you can provide for the transportation, you can take those cattle away for free. Price dropped to zero because the farmer's only choice at this particular point is if he takes the cattle back to his pasture land, he's going to have to shoot them. Now, even though the price at the auction clearinghouses pretty much well dropped to zero, just to get rid of that supply, it didn't preclude in subsequent years or even subsequent months the price coming right back up again. Because what happened in the next couple of years after those big droughts is it rained again. Pasture came up. The grazier can only make a profit by having his herds breed and bringing more cattle to market to sell. So he wants to rebuild his herds. So there were years of great demand for cattle, but the supply of cattle was in very short supply. So the only way a market clearinghouse auction mechanism can cope with large amounts of demand and small supply is to stick up the price. And then if you really, really do want the cattle, you will pay higher and higher prices to actually make them available to you. And that's how a clearinghouse works. Big supply, not enough demand, price drops to clear the volume. Big demand, not a lot of supply, price rises to clear the volume. So on the next slide, when we apply this clearinghouse mechanism to actual share prices, let's look at the live hire example again. The business floats and there are a lot of sellers. There is a lot of selling in that first 6 weeks and it drives the price down 50%. Now note, there's no change in value in this business at all. It's just big supply coming on and the stock exchange is just a clearing mechanism. Price drops to get rid of that higher supply. That doesn't preclude though, 6 weeks later, you'll see in the bottom blue chart, price starts to rise again. Demand is coming in, there's not a lot of supply of new shares, and slowly the price starts to tick up. That is the stock exchange as a clearing mechanism. That is all the stock exchange does. There is no regulatory authority judging valuation at all. People bring shares to the market to sell every day. People come to the share market each day to buy shares, and the stock exchange is just a clearing mechanism, just like an auction cattle yard. On the next slide, you'll see that actual recovery in live hire has actually continued beyond September into December, and the share price has just gotten higher. So certainly that 50% fall had no effect on the subsequent share price rise that existed for live hire. And the same was true of Platinum, and the same was true of Santos. Share price does not equal value. Every stock exchange is just a clearinghouse. On the next slide, we actually start to talk about what we've seen in the news and media about Bitcoin. Can't really have a discussion about Bitcoin without talking about the two underlying technologies that make Bitcoin happen. So we're going to talk about blockchain and we're going to talk about distributed ledger technologies. In the world today, when we process transactions and we exchange monies for goods and services, it's very much well done through centralized technologies, like a bank. The bank actually conducts the transactions for you between two individuals, or the stock exchange. You buy some BHP, you don't know the person that's selling them to you. You can't trust the person that's selling them to you, so you rely on a stock exchange or a clearinghouse to do that transaction for you and make sure it all happens appropriately. And that takes 2 or 3 days to actually execute. When we start talking about blockchain technology, this is a differentiator. This is very different to what you've experienced. We're moving away from a centralized clearinghouse and we're moving back to a decentralized transaction between two individuals. On the next slide, let's talk about that blockchain in a bit more detail. What is a block? A block is a piece of transactional information. Transactions that happen between two individuals or two companies. It's got some information about that transaction. It's got a timestamp on that transaction. In a blockchain, once that group of transactions happen, it goes into the network. And there are several different people in the network that can mine in and verify those transactions. So they look into the transactions, they verify, yes, an exchange happened here, it did happen at that time, and it verifies the transactions and then puts that into the blockchain. When these data miners go in and look at a blockchain, they look at all those transactions that have happened in the history of that blockchain right back into the very first one. In the case of Bitcoin, when a new block of transactions come up about every 10 minutes, the data miners come in, they confirm those transactions and they process those transactions right back through to the very first Bitcoin transaction that happened in 2009. Because there is a network of people that can log in and look at that, this is the power of your distributed ledger technology. Those transactions exist in an open way that any data miner can read on several 100,000 different servers. So you can't actually log back in and change the details or hack in and change the details of that transaction, because you can't find the 700,000 servers that transaction is sitting on. It is very open technology. It's an open ledger that anyone can look in and see. So blockchain and distributed ledger technology on hundreds of thousands of different places make it impossible for you to hack in and change those details and records. So on the next slide, we just see a quick example of how a transaction happens. Something's exchanged between A and B. Those transactions go into a block. That block is sort of radiated out to the network. The network come in and verify that that transaction has happened, and all the other transactions right back to the very first transaction. The transaction is approved, and it is then forever on the distributed ledger for anyone to see. As you join the blockchain network or you join the Bitcoin network, you can, if you want to, see that ledger right back to the very first ever transaction. So on the next slide, we actually explore what are the advantages of this. It's very transparent, it's very open, and it allows for instant transfer. So if we work through a bank, there's always a 2-day or 3-day delay while we confirm that the transaction happened. If we work through a stock market or a clearinghouse, there's always a 2 to 3 day delay while we confirm that that happens. The data miners can confirm that in a matter of seconds or split seconds. So it's instant transaction, instant verification. You don't need a middleman or clearinghouse. It cuts out a lot of cost, and it really speeds up the process amazingly. Blockchain technology will change the way that we do transactions in the future. It's a very, very exciting technology. That distributed ledger technology and that openness and that transparency is absolutely essential and exceptional. So I think we're going to hear more about these technologies as we move forward into the future. On the next slide, we're going to talk a bit more about how Bitcoin fits into this picture. But first of all, just a quick disclaimer. This is not a recommendation to buy or sell Bitcoin. There is no prospectus, there is no product disclosure statement about Bitcoin. This is not a buy or sell or hold recommendation. This presentation is for educational purposes only. What is Bitcoin? It's a type of cryptocurrency. How is it made? An algorithmic program was written back in 2008, 2009 using the blockchain technology and using the distributed ledger technology. The person who wrote this program, this algorithm, we don't know who they are. There is no person you can arrest and tell them, stop this program. You can't do that. There's no building that the federal police can storm into and seize the books and records and computer servers and shut this down. You can't do that. The Bitcoin algorithms have been replicated now on hundreds of thousands of servers around the world. People can transfer these Bitcoins between them. The data miners can verify those transactions and can verify those transactions right back through to the very start in 2009. You can't stop the Bitcoin program. There is only a limited number of Bitcoin available. There are about between 16 to 18 Bitcoins out in circulation at the moment. New ones get created all the time. So the reason why the data miners come in and verify these transactions right back to the start is they get paid in Bitcoin for doing that. There is only a maximum amount of Bitcoin that will ever be out there. That will be 21 million Bitcoin. That will happen in the year 2140. That's programmed into the algorithm. You can't go in and change that. Whoever did program Bitcoin can't go in and reprogram and give himself an extra 10,000 Bitcoin. It can't be hacked into that way. It's already out there on hundreds of thousands of servers. The people that use Bitcoin as their preferred cryptocurrency see it as very pure. It cannot be manipulated by a government. It cannot be manipulated by a bank. It cannot be manipulated by a company. It cannot be manipulated by a person. And that's where the trust in Bitcoin comes in. You can actually buy Bitcoin by going to a market. I used an example there of an Australian company like BTC Markets, and you can pay Australian dollars to get a Bitcoin. How do they buy and sell? How do they transact? It's exactly like a clearinghouse mechanism for shares. So if there is large demand for Bitcoin, you will see the prices go up to clear that demand. If there are a large number of sellers in Bitcoin, you will see prices go down to clear that sales volume. It will work as a clearinghouse like any other traded commodity, like traded shares. On the next slide, we will actually see just a few more features about Bitcoin and how it works, particularly for self-managed super funds. So don't be surprised with the market clearing mechanism that there will be big fluctuations. I read headlines in the newspaper, it's amazing, Bitcoin's up, 50% this week. That's not amazing. That's just the market clearing mechanism accounting for a lot of demand in the system at the moment. I think there's a lot of latent demand sitting out there for Bitcoin. The more it makes headlines, the more demand there's going to be. And I know how the market clearing mechanism will account for that. But beware, there is no intrinsic value to Bitcoin at all. It's more of a collectible item, like a piece of art or something like that. If demand for Bitcoin falls, then you will see a large fall in value. I also know, because there are no anti-money laundering or counter-terrorism financing laws that can apply to Bitcoin as it sits at the moment, what happens if a piece of news and information comes out by governments that a terrorist act was funded through Bitcoin? What happens if all governments declare it illegal and show you photos of burning children or dead bodies because terrorism was able to move funds from country to country very easily and fund terrorism? That's probably an example of a piece of news or information that could absolutely trash the Bitcoin price as everyone runs to sell very quickly. So whilst there could be exceptional demand for Bitcoin in the future, and the market clearing mechanism will have to account for that, please be aware there's no intrinsic value here. If there is some sort of piece of news or information that causes a rush of selling Bitcoin, you could easily see large price movements in the other direction. I've got a few notes there on some of the difficulties of perhaps owning Bitcoin in a self-managed super fund. It is difficult to get into the name of a self-managed super fund. On the next slide, once again, in the notes that we sent you, you'll have more detail on Bitcoin, on the terminology used, and Appendix 6 actually shows you other pertinent pieces of information and language that you need to understand, to be involved in Bitcoin. But once again, there's no recommendation of Bitcoin whatsoever. Also be aware that there are 700 to 2,000 different cryptocurrencies out there. Anyone can write a cryptocurrency program. A lot of them are being put out there by particular corporations, and there's a lot of investment going on in cryptocurrency at the moment. So we do think demand for cryptocurrencies might be tempted by the sheer volume of cryptocurrencies that are available. Bitcoin is very expensive now to transact in. There is a cost to actually use Bitcoin, and it's starting to be so high that small transactions in Bitcoin are not actually worth doing. So that's why a number of the players in the cryptocurrency space are using other currencies like Ethereum, Litecoin. I've listed some on the slide in front of you. That probably does it for Bitcoin at the moment. On the next slide, we actually had dinner with the Deputy Reserve Bank of Australia Governor, Mr. Guy DeBell, in Morgans in Sydney a couple of weeks ago. Up on the slide in front of you is a few of the key points that he made to us, and many of them we've already covered in previous economic updates, such as Europe is going great guns. Economically now, Europe is really helping to drive the world. Germany, lowest ever unemployment ever. There's fantastic news and information coming out of Europe. We know that the US is going very well. We also know that China and Asia is going very well. This global synchronized growth is quite incredible, and we've confirmed that before. He also thinks that we're definitely at the low of the credit cycle, which means interest rates right now are the lowest that they will ever be, and that the next move in interest rates is definitely going to go up. The final point I found very interesting from him is he does not read any media. That is the value that the Deputy Reserve Bank Governor of the Reserve Bank of Australia puts on media channels. As we've highlighted several times, media is there to grab your attention and to sell advertising space. It's not there to report the news. It's not there to report information. The only reason they say anything at all is to sensationalize it, grab your attention, and sell advertising space. Your Deputy Reserve Governor puts zero value on that. On the next slide, we're going to go into presentation here from Kerr Neilson in terms of China and Greater Asia. Just a quick reminder of the Chinese story and just how amazing it is. You see those two photos in front of you. One is of Shanghai in 1990 and the other one is of Shanghai in 2010. No other country, no other group of cities have been able to have that explosive growth, to build that amazing infrastructure, to put all that fixed asset construction in place exactly like China has. And from Kerr's perspective, it's pointless talking about global growth without actually considering what's going on in China and the greater Asian region right now. On the next slide, we see a few more points about China and the economic growth miracle that it really is. Kerr is very disappointed when he talks about the news and information that seems to be available through media channels, there's that media thing again, about China. He finds the overall tone very negative. He finds that the news and information is well out of date. He finds that the news and information has interpretations that their on-the-ground team in Asia and China don't actually see and don't actually agree with. In 2016, we started reporting on China closing down inefficient factory production of steel and inefficient coal mining production. At the time, there was a lot of news about the problems that China had with debt in state-owned enterprises and a lot of debt that it had in actual individual businesses. Closing down those inefficient factories in steel and coal allowed the coal price to rise inordinately. And on the next slide, we can see, I haven't been able to include the slides of the coal price in it, but you'll find it in previous economic updates. But there have been large rises in the coal price. The next slide will actually show us that, thank you. The price rise in coal has been amazing. You can see that on the blue line in front of you. The steel price rose along with that. So closing off this inefficient production made the bulk of Chinese businesses in these industries highly profitable, and they have had no problem now paying down their debt. This is something that other economies in the world can't manage because they aren't centralised economies. There's no edict from the Australian government that BHP has to shut down 15% of its coal mines to actually help the coal price increase. But in China, all that is possible within the matter of a month. So it's very important that the Western view of how China works and operates often misinterprets what China is trying to do. If we step ahead to the next slide, you can see that GDP growth in China has been incredibly strong, and actually GDP growth in the entire Asian region has been strong. Growth like this is giving the Chinese consumer more monetary power to go out and buy and consume things. And we've talked about before of how Western economies are 70% driven by consumer spending. In China at the moment it's 50%, but it's growing all the time, and it's growing with more and more money, and it's growing with more and more leverage. On the next slide, we can see that in terms of education within China, very important. The number of extra patents that were registered in China has risen inordinately from one year to the next. And it's now almost catching up to some of the biggest patent registers in the world, like the US. At that rate of growth, they're likely to exceed Western countries within 2 or 3 years. Also, the trade between Asia itself has grown enormously. The 57% of all trade now with China is with the greater Asian region. And only sort of 16% is with the US, and only 12% is actually with Europe. That means supply shocks and economic shocks in Europe and the US will have excuse me, less and less effect on the China and greater Asian region. On the next slide, some other key things are going on that you've got to be aware of. Very high savings rate is very good for them. Their services sector is accounting more and more for economic growth. 117 million people left China last year to go travelling. That is the greatest number of tourists that any country has ever pushed forth within a single year. Those numbers are going to continue to grow hugely. I'll leave those other positive factors for you to read, but obviously Asia as a source of world growth is taking a larger and larger percentage of the growth pie. You'll actually be able to understand that in areas such as Europe, the populations are shrinking. So Asia is going to have more and more of global growth. It's going to become more and more important to the world and how business is done to the world going forward. In the next slide, just a quick look at the US. Trump is managed to get agreement in both houses of Parliament now to his tax cuts, and that is essential in the next slide to recognising how operating earnings for American businesses are going. They are at record highs. These tax cuts will come through and they will go higher. Now don't forget what I said before, that markets have already predicted this. Markets have already started putting that into share prices, and thus US shares are at an all-time record high. On the next slide, just a quick discussion here. We had the mining construction boom, which started to wound down sort of year after year. The infrastructure construction boom that's coming for Australia is going to be 4 to 5 times as big as the mining construction boom was. And that is going to be pretty exciting for building materials companies, pretty exciting for engineering and engineering services, pretty exciting for some of the mining engineering services and the goods and commodities that need to be supplied in order to sustain that level of construction you can see on the graph coming forward. So exciting times for those particular sectors of the Australian marketplace. On the next slide, this is just a quick reminder of the various things that are affecting the large Australian banks. So you can see over the last 3 years, the share prices of Australian banks have gone nowhere. This is very important. We've always stated that we don't believe there will be much growth coming from this segment. And whenever governments want more money, they put a tax on the banks. And we've also seen coming up a royal commission into the banks. They will look at the way the banks transact, they will look at the bank's businesses themselves. If they find any skeletons in the closet, there's going to be calls for economic redress. And that may see monies paid out by the banks to certain individuals or companies. So as this commission goes on, it will be a sign of risk to the banks. On the next slide, we summarise some of those key points for you, which you can read at your own leisure. But just be aware, we don't view the banks as growth investments. We view the banks as income investments. The Morgan's model portfolio for the banks on the growth side only has about 10 to 11% exposure to large Australian banks. On the next slide, probably pretty important to look at what's been happening in major global indices. We said that Europe had been doing very well. We said that Asia had been doing very well. And the Chinese index there in the grey has recovered quite well. In the blue line, that's the Australian market. You can see that it hasn't moved very much. Excuse me. Because the rest of the world is doing so well and we've got synchronised global growth, these other economies will drag Australia along with it. Yes, there will be a lag. Yes, we are experiencing that lag now, but businesses in Australia will be able to benefit from the synchronised global growth that's going on at the moment. In the next slide, it's a good reminder that I've always been saying that the top 20 businesses in Australia, that is the blue line on the bottom chart over the last 3 years, we don't think that they're going to have a lot of growth in them. And a lot of our growth model portfolios and examples have been smaller businesses and outside of the top 20. The mid-cap indice, which is the red line, the small cap indice, which is the brown line, and the micro-cap indice is the green line. I've always said as stronger business conditions come in, those segments of the market will be far better rewarded than the top 20 of the market will, and that has definitely been the case. Business confidence in Australia has never been so high. We are actually at record highs for business confidence, and that's going to keep feeding into the prices at the smaller end of the Australian market. Just quickly, on the next slide, we're having a look at the oil price. It's actually come up about 35% since the 30th of June. This has not fed yet into oil and gas stocks. So we are actually quite excited for energy in 2018 as the market comes to accept that we do have higher pricing for oil now, and that pricing is likely to be priced out over the next 10 to 20 years of oil and gas companies' earnings. So the growth for energy shares should be quite strong. On the next slide, just a quick reflection of our fixed interest strategies for you. We know that bond yields are rising. We know that that means longer dated bonds are going to come down in value. So we have no exposure for you in long dated fixed interest bonds. We are in corporate floating notes. So the Morningstar returns down the bottom of this page in the orange and the yellow for Australian fixed interest, 0.2 of 1% last year. For international fixed interest, 0.5 of 1%. In traditional fixed interest products, we think these low returns will go on for quite a number of years. Your floating rate corporate notes from the largest Australian businesses, the tier 1 issuers that we can provide, are providing you with interest payments of between 5.5% and 6.5%. And because these notes are so rare, and it has been recognised that fixed bonds at the long end will probably come down in capital value, we're seeing more demand. So we are getting an increased positive capital position on our notes as well. On the next slide is just a reminder of our strategies, avoiding the bonds and coming into fixed interest notes. We are aware that there are some risks to the capital price of bonds, particularly as the quantitative easing programs of the central banks are wound down. A quick look on the next slide. It's just important to note interest rate rises are coming for Australia. We think they'll come in at the tail end of 2018, As that happens, as interest rates rise on your floating rate notes, you will get the benefit of that immediately. On the next slide, we did look at the MCP, Metric Credit Partners, diversified floating rate note bond fund. It was issued to us at $2 a share. It's been trading between $2.08 and $2.12. That's a great kick in capital value for us. It does pay a fixed margin, 3.25%, over the RBA rate of 1.75%. 1.5%. So we're getting 4.75%. As interest rates go up on that bond and subordinated debt floating rate portfolio, we will get the benefits of those interest rate rises very quickly. And it's going to be very well diversified across 60 to 80 different businesses. We will look forward to reporting to you again in March next year, and please have a safe and happy festive season from all of us here at Morgans. Thank you.